The gold to silver ratio over 100 years, a centennial trade. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Dhruv, who's been exploring the concept of the fourth turning in further depth this week. It's something he's been talking about a little bit to us a few times now, but this time he's specifically looking at how the gold to silver ratio plays out in different market regimes. How are you going today, Dhruv?
Good, Chris. Thanks for having me back on.
Thank you for coming on. This is an interesting topic. It's one that you, like I said, you've sort of touched on before, giving us a little bit of an overview. But I thought it was really interesting today that you went into the gold silver ratio specifically to talk about how that performed throughout those effectively four different cycles of those four turnings. Can you maybe start us off today by giving us that little bit of an overview again of what the four turnings were, but also why it's so significant, and why it seems to be so significant for the gold silver ratio in particular.
Yeah, absolutely. So the four turnings, it's a theory that talks about society moving in 80-year cycles. The 80-year cycles can be broken up into four 20-year subcycles. Each cycle is called a turning. Each turning has a very specific generational archetype, specific types of challenges. The way the economy moves and different markets move tend to be cyclical following this pattern as well. And what we see is one turning leading to another. So there's a very predictable result moving from one turning to the next. As you get to the fourth turning, you get to the end of the 80-year cycle that leads into the first turning of the next macro cycle. And understanding this will help put things in perspective where people look around at the current happenings in the world. They seem unprecedented, but it's not that they're unprecedented. They just happen in your great grandparents' time. And so you might not know about them. And these cycles have been extrapolated backwards of like 700-800 years, and they do seem to fit quite well.
Very
Now,
interesting. So I just wanted to dig in on that. When you talked about that happening, I mean, it's a really such a valid point that it's your great grandparents' time. It's not something that you've experienced before. This is 80 years is longer than any of us have been around to. And even if you were 80 years old, you wouldn't remember what it was like back when you were born. So with that in that context, it's so large that it's not surprising that no one really remembers a similar time to this. Is that what you're sort of saying there?
exactly right. So the reason we are doomed to repeat the same mistakes of history is because, like, we might speak to our grandparents about what their lives were like, but if our grandparents were 3, 4, 5, 6 years of age during the previous fort turning, it's not really our grandparents that were
Mm.
conscious about what was going on. It's our great grandparents that were in their 20s and 30s during the previous cycle when it was back at where we are today. They would have been conscious about the socio-political concerns, the economic issues, and the things that were happening around them, and they would have been able to make sense. Now, it's not like they're going to pass that information on generation after generation because it seems to almost be irrelevant once it's three generations down
Mm.
the track and it's like, oh, we live in a different world now. But really, it's just as it seems completely irrelevant is when it immediately becomes relevant again. So what you want to be doing is 80 years ago, your great grandparents would have been 30. If they just had a diary, if you read the diary of your great grandparents, that would be extremely relevant to you today.
That's absolutely fascinating to me, just as a concept. And I sorry because I interrupted you, and you would have we're going to go on and talk about the gold silver ratio during those turnings as well. Can you sort of talk to that a little bit?
Yeah, overlaying the gold to silver ratio over this 80-year cycle is so fascinating because the gold to silver ratio also seems to go through one complete cycle over these 80 years.
Mm.
And I overlaid it just out of interest because I'd seen the gold to silver ratio over the last 20 years and then the 20-year cycle before that. And I've been looking at these 20-year land cycles that we've discussed a few times as well. But what I found is when you overlay four land cycles, one over the other, they fit very well into this fourth turning theory. And so I thought, well, what happens at the end from one fourth turning going into the first turning? Well, what happens with the gold to silver ratio at that point? And it does seem to complete one proper cycle. So really, to give you a broad overview, if you look at the fourth turning moving into the first, that's when the gold to silver ratio seems to be topping. Now, the gold to silver ratio will tell you how many ounces of silver give you 1 ounce of gold. So what that means is when the number is high, silver is cheap when it's priced in gold. It's undervalued when it's priced in gold. So if the gold to silver ratio is sitting at around 80 and you buy a bunch of silver, then the gold to silver ratio, let's say, drops down to 40, and you trade that silver in for gold, you've doubled your gold holdings compared to what you would have had if you had just directly gone into gold to begin with. So this gold to silver ratio is something that a more active precious metals investor will keep an eye on with the view of maximizing their gold holdings, making sure that in the downside, the downward price action is limited by holding gold, and in the upside, when silver is outperforming, that the capital growth is maximized by holding silver. Now, in the fourth turnings, the gold to silver ratio is topping. What's happening with silver at that point is silver is just getting into a bullish breakout against the dollar. So it would have gone into a massive accumulation range, and it's starting to break out into price discovery. So silver, people are starting to pay attention to. At this point, the gold to silver ratio is actually topping. That is in the fourth turning. Now, coming into the first turning, which is, the start of the 80-year cycle, you actually see the gold to silver ratio have a massive drop off. And a drop off at this scale seems to happen once every 80 years. So in the previous first turning, which was after World War II, so we're looking at 1945 to about 1965, 20 years, you saw the gold to silver ratio drop from the range of about 90, 85-ish, all the way down to about, I think it was 16 or 17, so below 20, which is unprecedented. I mean, talking about, quadrupling your gold holdings in that situation. And now that happened over 20 years. Now, in the second turning, as you move from the first to the second, the gold to silver ratio starts to bottom out. So it takes about 20 years for it to put in a bottoming pattern. At this time, it's actually a good idea to be buying gold or holding gold. Or aggressively, if you've got any silvers that you're still holding, start converting your silver to gold, because you've seen massive gains from a high gold to silver ratio to a lower gold to silver ratio. So, just to take a step back, when it's high up, you're buying silver. When it's falling off, you're dollar cost averaging your silver into gold. When you see it at the bottom, bottoming out, you want to then aggressively convert your silver to gold, or just buy gold if you've got dollars to work with. Then as you go into the third turning, you see the gold to silver ratio shoot back up, a very sharp rise over 20 years. At this point, you want to be converting your gold into silver, averaging your gold into silver as it goes up. At this point, silver's basically gone into another accumulation phase against the dollar. That's in the third turning. And then as you go from the third turning to the fourth turning, you see the gold to silver ratio topping. And in the fourth turning, it puts in a topping pattern. That's back to where we are right now. At this point, people want to be buying silver or converting their gold to silver if they want to be aggressive. I personally wouldn't ever recommend converting gold to anything. It is the final destination in my view. But if you've got dollars, it's a good time to buy silver in the fourth turning, with the view that as you get into the first turning of the next cycle, you'll see that sharp drop off again. That's a good time to average your silver into gold, and the whole cycle continues. Now, we'll have a chart up on the screen of this whole thing that I've just spoken about to make it a bit clearer. But really what you're looking at is a first turning where, in terms of what the turnings are as well, I'll just give you a little bit of information so that becomes a bit clearer. But the first turning is where you've just had a massive crisis. Last time was after World War II. You see a lot of hope, optimism, unity, big institutions are set up. From that, you have 20 years of that. Then you move into the second turning, where it's more a rise of individuality. These institutions are sort of viewed with a little bit of distrust. That was in the 70s and the 80s. Then you go from the 80s to the 90s into 2000. This is where individualism is well and truly alive. The institutions are looked at with a lot of distrust. There's a lot of very loose financial policy, monetary policy. Spending is out of control, very low taxes, a lot of liquidity into the system. And that leads into the fourth turning, where there's a lot more crisis, a lot of financial cracks in the system leading into financial collapses. You see wars breaking out, you see revolutions, and you see systems being torn down to rebuild new institutions, which leads into the first turning of the next cycle for the next 80 years.
So I want to ask a question to sort of to follow up on that explanation, which was fantastic. It really covered that in a lot of detail. The crisis angle. We know that from how you've described it and what you talked about in the article, that you've got these crises that come particularly in the fourth turning. It's kind of what is necessary to cause the first turning from how you've described it, like for that refresh to happen. So what is it that drives silver's price higher, and what makes it stronger during that period of time? Because that will be quite interesting, I think, because a lot of people wouldn't really understand how that's going to unfold, or what the mechanics are behind that. And also, how do you identify that optimal time to do it? Is it just, I mean, you've used the number 100 there and saying, sort of large numbers around 100 are large historically. So is that what you look for? Just a historically large number to make that switch? Do you do some kind of dollar cost average that you're sort of talking about? How do you address that?
Very good question. So in terms of timing it, there's two aspects to it. But first, I'll just cover what actually causes the spike in silver price as you get through this crisis situation. So, leading into the crisis, it's actually gold that's outperforming silver because everyone's looking for a safe haven asset. No one's trying to squeeze every ounce of speculation out of the market. And you see gold and silver moving up together, but gold is outperforming silver. This is during the fourth turning before the crisis, or let's say during the crisis. And that's when the gold to silver ratio is putting in that topping pattern, which we've seen happening over the last 10 odd years, where we've been sitting between 80 and 90. And a lot of people are being like, well, why is it so high? Is it ever going to fall off? But these things take a long time to play out. So the attitude that's really rewarded during four turnings is patience and risk aversion.
Hmm.
So what happens when after gold to silver ratio has been up at those levels for a long period of time, the crisis will eventually hit. When the crisis hits, you see a final spike in the gold to silver ratio where everyone's just battened down the hatches. And then once the crisis passes, you'll see most other markets really struggle to recover. And gold has been going on this uptrend for years and years with silver. And the general investor looking around will start to notice this.
Hmm.
That's when speculation starts to come into the precious metal space, and people will look at a option between gold and silver, and they will try to squeeze every ounce of speculative profit out of the market by moving into a asset option that has a smaller market cap and lower liquidity. And the same amount of dollars moving into the silver market will cause a much higher price rise in a percentage term compared to gold, simply because of the lack of liquidity and the smaller market cap. So what you start seeing after the crisis is silver outperforming gold in a big way. And that's when you start seeing the gold to silver ratio fall off a cliff. And people are then in a frenzy piling into the silver market. Everyone's sort of trying to board a moving train. In terms of timing it, there's two aspects to it. You're looking at the cycle and where we are. So you can say, okay, well, we're in the fourth turning. Are we before the crisis? Is the crisis ongoing? Because quite often you're in the crisis and you don't realize until you're
Hmm.
most of the way through the crisis. Are we in World War III already? Is it something that's going to happen later? So I think trying to get too specific with the timing is a little bit risky,
Yep.
versus just keeping it really simple and looking at the gold to silver ratio, saying, well, we're in the fourth turning, it's a 20-year period. The gold to silver ratio is putting in a topping pattern that could take some time. It's at the 80, 85 level. The previous time this happened, it moved from that 80 to 90 all the way down to 15 to 20. So while it's in these higher ranges, I'm going to buy silver, I'm going to load up. And as it starts moving down, which is a long process once we go past the crisis into the next turning, into the phase of optimism and hope and the first turning of the next cycle, when you see silver going parabolic and euphoric, that's actually the time to be converting your silver to gold. When everyone else is piling into silver, when everyone thinks it's the best asset ever, you've already front run the market. You've gotten into your silver when the gold to silver ratio is high. When everyone's talking about how great gold is because gold's outperforming silver, you've gotten into silver. Then you see the gold to silver ratio fall off. You'll see silver outperforming gold, and that's when you're, averaging into the gold market from silver as the silver price goes parabolic in dollars, as the gold to silver ratio falls off. Then you've got your gold holdings, and then when the gold to silver ratio is at a very low level, you can get rid of the last bits of your silver into gold and then just stay in gold. If you want to keep averaging further into the market using dollars, at that point, just stick with gold. So it's really a question of positioning yourself early on, being patient, front running the market, and basing it more on the gold to silver ratio, that when it's high up, get into silver. as it's dropping, average into gold. And once it's at a very low level, really back up the silver truck and convert most of it to gold at that point.
That's fantastic advice, I think. You've really outlined a plan that people can use there. So if you're, this is probably the last question just to wrap this up. If you're the average retail investor and they can follow those practical steps because you just gave them an outline of what they could do. And as you've said, it's a once in a century opportunity, certainly once in a lifetime opportunity now to take advantage of that. My final question then is, what are the pitfalls? What are the things that stop people from taking advantage of this, or that you can see could be the potential pitfalls for them? Just to sort of address that other side of it of what should we be on the lookout for if you're a retail person coming into Ainslie, you go, yeah, okay, I get that makes a lot of sense. I want to get some silver. I understand how this is likely to play out over that long term.
I think the pitfalls in this opportunity are the same pitfalls that apply to any investment opportunity. I think the same concepts will apply. And we touched upon this a little bit in the previous question as well, but following the herd is always quite dangerous. When everyone and their neighbor is talking about how great a certain investment is, it's probably time to start averaging out of that market. When you see people getting frustrated with a certain asset class, it's probably, and this can be a little bit difficult to build your conviction in, but that's when you really want to be getting into that asset class. And a way to have that conviction is to study and to have your decisions be based in data, in cold, hard data, and not in emotions. So you're not looking at something that looks like the best thing ever and then getting greedy, making a decision based on greed. You're not looking at an asset that hasn't moved and getting frustrated and making a decision based on frustration or fear. You're looking at data, you're looking at numbers, and numbers that go over 80 to 100 years are very hard to argue with. So they've proven themselves over 10, 80-year cycles. I mean, you're looking at like 1,000 years of data at that point. So I think not following the herd, not basing it on emotions, front running the general market can be achieved using data. And the last thing I'd say is also just being aware of mainstream media and news. So if you start seeing every news channel talking about how great silver is, by that point it's getting a little bit late in the cycle. That's a good sell signal. When you start seeing, and I won't name names, but I think we all know who the reverse indicators are on the news shows, and there are ETFs based on this as well that you can invest in that actually seem to perform quite well. But when you start seeing the BIM Bramers out there talking about certain assets and you want to front run the market, that's a good sign that you can start averaging out. So don't base things on news, don't base things on hype, look at data, and don't invest using emotions. And I think patience is another big one for the fourth turning as well.
Look, that was an absolute masterclass on this today, Drew, really looking at all of those aspects that make up the fourth turning for starters, but also the specific way you can play it with that gold silver ratio. Absolutely valuable content. Really appreciate your work and that deep dive on that today. So thank you very much for that.
Awesome, Chris. Thanks for having me on.
Thank you everyone for watching. We'll chat again soon.